Welcome to another episode of Delta Investments Deep Dive,
Yeah.
where we go in depth and unpack our research on specific stocks and discuss the risks. We are recording this episode on Thursday, March 5th, 2026. In this episode, we want to turn our focus on the housing market and really explore some trends and patterns that affect the housing sector, broader markets, and a look at one of the companies that could potentially be a key player. And specifically for today's mission, we're going to explore the absolute roller coaster journey of Opendoor Technologies.
Yeah, ticker open on the NASDAQ.
Exactly, ticker OPEN. And this is a company that, they haven't just participated in the iBuying space. For a very long time, they completely defined it.
Oh, absolutely. They were the poster child.
Right. But right now, they are executing what their leadership is calling a massive Opendoor 2.0 turnaround. And this is all happening under their new CEO, Kaz Najatian.
Who is a fascinating figure in his own right.
Very much so. We'll get into his background, but they are aggressively pivoting away from being this capital-heavy prop desk.
Essentially, a company that just buys a ton of houses and holds them on their balance sheet.
Right, taking on all that risk. And they are attempting to completely refound the company as an AI-native software platform.
It's a huge shift.
It is. And their stated target is incredibly ambitious. They want to hit adjusted net income profitability by the end of 2026. So if you are listening to this and you have ever bought a house, sold a house, or even just felt that familiar sense of dread thinking about the sheer friction involved in real estate, this deep dive is definitely for you.
It really is a fascinating pivot, and I think to truly appreciate what Opendoor is attempting to pull off right now, we have to rewind just a bit.
Yeah, let's set the stage.
We have to understand the sheer scale of the problem they originally set out to solve back when they were founded in 2014. Because the U.S. residential real estate market is undeniably massive.
Staggeringly huge.
Right. We are talking about an industry that, as of 2021, represented nearly $2.3 trillion in transaction value.
Trillion with a T.
Trillion, yes. Housing is actually the single largest consumer expenditure in the United States. It easily outpaces transportation, food, insurance.
Healthcare.
Yes, healthcare too.
Which, it makes sense, right? It's the roof over your head. It's the biggest purchase you're ever going to make.
Exactly. Yet despite that massive scale, and despite the absurd amount of capital flowing through it every single year, the online penetration remains staggeringly low.
It really is.
Even at the absolute height of the iBuying boom a few years ago, online transactions represented less than 1% of the total market.
Less than 1%. Okay, let's unpack this.
Yeah.
Because that is wild when you really sit back and think about it.
It's almost unbelievable.
We buy our cars online now. We book complex international vacations online. We manage our entire life savings, our retirement accounts through apps on our phone.
No fingerprint swipe.
Right. But when it comes to the biggest financial transaction of our lives, the process is stuck in the dark ages. The incumbent traditional process is still 90% agent-led.
And that traditional process is incredibly bloated. When you look at the life cycle of a standard real estate transaction, it involves an average of roughly 6 different intermediaries.
6. Let's actually count them out for the listener, because I think people forget just how many hands are in the cookie jar during a closing.
Oh, for sure.
So you have your listing agent, obviously.
Right. Then you have the buyer's agent. You have the title company.
That's 3.
You have the escrow officer coordinating the funds. You have the home inspector.
5.
You have the appraiser. And honestly, often you have a mortgage broker or loan officer on top of that.
So that's 6 or 7 separate parties. And every single one of these intermediaries represents a potential bottleneck.
Exactly.
It's like a giant Rube Goldberg machine. You drop a marble, it rolls down a track, hits a domino, which knocks over a candle, which burns a string.
That is the perfect analogy for it.
Right, because if any one of those 6 intermediaries drops the ball, like if the appraiser comes in low, or if the inspector finds a weird stain in the attic, or if the underwriter asks for another bank statement on day 29, the whole machine just breaks.
And the data shows exactly how often it breaks. There is a 20% contract fall-through rate in traditional real estate.
20%.
Meaning 1 in 5 times you go through this entire 90-day ordeal, you pack all your boxes, you schedule movers, and the deal just collapses before closing.
That is a source of immense, just visceral anxiety for consumers.
It truly is. And what is fascinating here is why. Why has real estate resisted digitization for so long, especially while every other major economic sector fell to software years ago?
Yeah, why is it so stubborn?
It really comes down to a few structural factors. First, the extreme fragmentation of the industry. There are over 3 million licensed real estate agents in the U.S.,
Wow.
but the average agent completes fewer than 5 transactions a year.
Wow, okay, so it's highly localized.
Exactly. It's a cottage industry. It is not standardized at all.
Not even a little bit.
Second, there is the emotional weight of the transaction. A home is not a standardized commodity like a share of stock.
Or a used Honda Civic.
Right. It is where people raise their families, celebrate holidays, build their lives, and because of that, the pricing and selling process is deeply personal and highly subjective. Sellers always think their home is worth more because of the memories attached to it.
Oh, absolutely. It's like, my kids learned to walk in that hallway, so obviously we need to list it for 20 grand over the comps.
Precisely. The
Mhm.
emotional premium. And the third factor is the hyper-local variables. A house on one side of a busy street might be valued entirely differently than a nearly identical house just 2 blocks away.
Because of school district lines or traffic noise, or even the direction the backyard faces for the sun.
Yes. Traditional tech platforms really struggled to account for those hyper-local, unstructured data points. They could give you a rough estimate, ballpark figure,
Yep.
but they couldn't give you firm liquidity based on that estimate.
Which brings us to Opendoor's original proposed solution. They launched these 2 core products that honestly sounded like science fiction at the time. Sell to Opendoor and buy with Opendoor.
It was a massive paradigm shift.
Yeah, the pitch to you, the consumer, was revolutionary. Instead of dealing with staging your house, keeping it perfectly clean for weeks, and having strangers walk through your living room while you're trying to eat dinner.
The worst part of selling a house.
The absolute worst. Instead of that, you just go to their website, you type in your address, you get a preliminary offer, they do a quick assessment, and they give you an instant all-cash offer.
And the most critical part of that offer was the flexibility. You get to pick your exact closing date.
Yes. That fundamentally changes the experience. It takes that absolute nightmare of contingencies we just talked about, that whole Rube Goldberg machine,
Yeah.
and turns it into something as simple as tapping a button on a mobile device.
Mm.
They wanted to replace the machine with a single switch.
And we really cannot discuss the value proposition of that single switch without addressing what the real estate industry calls the double move dilemma.
The double move. Yeah, this is huge.
When you look at the historical data, over 2/3 of home sellers are also home buyers at the exact same time.
Right.
These people are essentially trapped in a massive financial and logistical paradox.
Let's break that paradox down for the listener. Say you live in a starter home right now, and you just had your second kid. You need a bigger house.
Yep.
But all of your net worth, your equity,
Yeah.
is locked completely inside the walls of that starter home. You desperately need that cash to afford the down payment on the new house.
Right. So to unlock that equity, you have to sell first. But if you sell first, where do you live while you are shopping for the new home?
You're homeless, basically.
You are forced to move your entire family and all your belongings into a short-term rental or an extended stay hotel.
That is the dreaded double move. It is incredibly expensive. You are paying for moving trucks twice. You are paying for storage units.
And it is highly disruptive to your family's life, especially if you have kids in school.
The alternative is just as bad, honestly. You try to go house hunting, and you submit an offer on a new home that is contingent on the sale of your old one.
Good luck with that.
Right? In any kind of competitive market, a seller is going to look at your contingent offer, laugh, and throw it straight in the trash because they have 3 other offers from people who have cash ready to go.
Exactly. A contingent offer is incredibly weak. So Opendoor's flexible closing date and their all-cash backing were designed explicitly to solve this exact pain point. By guaranteeing the sale of your old home on your exact timeline, they eliminate the overlapping mortgages and completely eradicate the double move.
You close on the old house the exact same day you close on the new one.
It's seamless.
And for a while, it really seemed like they were genuinely going to conquer the world with this model. When you look at their peak scale just a few years ago, the numbers are jaw-dropping. By 2022, Opendoor generated $15.6 billion in revenue.
Incredible volume.
They bought and sold over 39,000 homes in a single year. They were operating in over 50 markets across the country. They were a total juggernaut.
They were, but
And here is where it gets really interesting. Despite that massive scale, despite printing $15.6 billion in top-line revenue, they posted a net loss of $1.35 billion for that year.
Yeah, that is a staggering number.
It wasn't a sustainable victory at all. And that brings us to the macroeconomic squeeze and what industry insiders now refer to as the existential winter of the iBuying industry.
Right. To understand how a company can lose over $1 billion while doing that much volume, we really have to look at the broader macroeconomic environment from roughly 2022 through 2025.
The macro shock.
During this period, the U.S. residential real estate market experienced one of the most violent shocks in modern economic history. The Federal Reserve, which was actively combating runaway inflation, raised benchmark interest rates from a floor of essentially 0.25% all the way up to 5.50%.
And later dropping slightly to 4.50%, but
Yeah.
still. Which, it doesn't sound like a huge number in a vacuum to a layperson, going from less than 1 to 5. But for mortgages, it's catastrophic.
It is entirely transformative. This dramatic, rapid increase in the cost of capital completely altered the affordability math for the average American homebuyer overnight. Mortgage rates spiked to levels we hadn't seen in decades
That crushed buyer demand instantly.
because the monthly payment on a $400,000 house suddenly doubled.
Exactly.
Yeah.
But the really insidious part of this rate shock was the unprecedented supply-side phenomenon it created, which is known as the lock-in effect. Okay, let's unpack this lock-in effect because it is crucial for you, the listener, to understand how this literally froze the entire housing market solid.
Please do.
Imagine you are living in an apartment right now with incredibly cheap rent-controlled pricing. It's a fantastic deal, but it is a little too small for you, and maybe you want to move closer to your new job.
Okay.
But you do the math, and if you leave your current building, your rent on a new, similar apartment across town will be 3 times as high. Are you going to move?
Absolutely not.
No. You are going to stay put, buy a space heater, put some shelves up, and deal with the small apartment.
That is a perfect analogy, and that is exactly what happened to millions of American homeowners. During the pandemic, when rates were at rock bottom, millions of people refinanced or bought homes, locking in 30-year fixed-rate mortgages at 2.5 or 3%.
Dirt cheap money.
Fast forward to the rate hike cycle. If they sold their current home to buy a new one, they would be trading their 3% mortgage for a new mortgage at 7 or 8%.
It made absolutely no financial sense to move.
None. Unless forced by death, divorce, or a massive out-of-state job relocation, people just stayed put.
So nobody sold, inventory dried up entirely.
Yeah.
The transaction velocity of the entire U.S. housing market just ground to a total halt.
Precisely. And for a company like Opendoor, which relies completely on transaction velocity to maintain the health of its massive inventory, this was devastating.
They were caught holding the bag.
They were holding tens of thousands of homes on their balance sheet, right as the music stopped playing. And furthermore, as we look at the later data, this macroeconomic deterioration was actually compounded by geopolitical and trade development.
Right, the 2025 stuff.
Specifically, following the announcement in April 2025 by the presidential administration of new and proposed tariffs on foreign countries, the broader market saw further deterioration in macroeconomic indicators for the housing sector.
And just to pause here for a second and be absolutely clear to our listeners, because tariffs are obviously a very politically charged topic.
Yes, they are.
We are evaluating this tariff impact strictly as an economic variable. That's it. A variable that affected interest rate expectations, supply chain costs for home building, and just broader market confidence. We aren't taking any political stance on the policy itself from the left or the right.
Yeah.
We're just looking at the math.
Exactly. The geopolitical climate is just another input into the risk model. And the fact remains that the market interpreted these tariff moves as inflationary, which added another layer of extreme uncertainty to the rate environment. And that forced Opendoor to dynamically adjust its pricing strategies and drastically increase its spreads to mitigate risk.
Okay, you brought up a crucial term there, the spread.
Yes.
That word is so important to this whole story. Can you break down for us exactly what the spread is in the iBuying world and why these interest rate shocks essentially broke the algorithmic pricing models that these companies were relying on?
Gladly. In the iBuying model, the spread is the financial cushion the company builds into its offer. It is the difference between what their pricing algorithm believes the true open market clearing value of the home is and the actual cash offer they present to the seller.
About it.
And that's before they even subtract their service fee, which for Opendoor was standardly around 5%.
So let's use a real number to make this concrete. Say the algorithm looks at my house and says, this will sell in the open market for exactly $400,000.
Right. So the algorithm predicts a $400,000 clearing price. Opendoor isn't going to offer you $400,000 because they have to take on the risk of owning the asset.
That makes sense.
They might build in a discount, the spread to account for holding costs, the cost of capital, and potential market fluctuations. Maybe they offer you $380,000 and then they take their 5% fee out of that.
Okay.
When interest rates are low and predictable, and homes in your neighborhood are reliably selling in 30 days, their algorithms can model that spread with razor-thin precision. They know exactly how much 30 days of property taxes, insurance, and interest will cost them.
So it's a highly calibrated machine.
Extremely calibrated. But when interest rates violently spike, the future clearing price of a home becomes wildly unpredictable.
Because the buyers disappear.
Exactly.
Yeah.
A home that the algorithm confidently predicted would sell in 30 days might suddenly sit empty on the market for 120 days or 100. The holding costs are ticking up every single day.
Right.
The interest they are paying on the debt they used to buy the house, the property taxes, the utilities, the maintenance. Eventually, those holding costs eat through the spread entirely.
And then they are underwater.
Yes. The company ends up selling the home for less than they have sunk into it, resulting in massive losses on the inventory they already hold on their balance sheet.
They basically catch a falling knife.
That's exactly what happened.
And the financial devastation from catching that falling knife is laid completely bare in the company's SEC filings. We are looking at a company that saw its revenue absolutely plummet. From 2023 to 2024, revenue dropped 26%, going down to $5.15 billion.
A huge drop.
Total homes sold dropped 27%, and by the end of 2025, the net losses hit $1.3 billion again.
Now, to be fair to the data here, and to give the complete picture, we should note that the 2025 net loss figure did include a massive, non-recurring $933 million loss on the extinguishment of debt.
Right, I saw that.
That was essentially a balance sheet maneuver to restructure their liabilities, not pure operational loss on homes. But even factoring that out, the operational bleeding was profound.
It was a total bloodbath. This existential winter was so brutal that it completely cleared the competitive landscape.
It did. If we connect this to the bigger picture, this macro squeeze caused major, incredibly well-capitalized competitors to just throw in the towel. Zillow, which is arguably the biggest brand name in real estate tech. They completely shut down their Zillow Offers iBuying program.
Just entirely closed it.
Redfin exited the space as well. They looked at the balance sheet risk, the terrifying inventory write-downs, and the sheer unpredictability of algorithmic pricing in a volatile rate environment, and they decided the juice wasn't worth the squeeze. They shut their programs down and took massive write-offs.
Which leads to the obvious question, and I want to push back a bit here to represent the skeptical listener. Zillow is an absolute giant. They have the Zestimate, which everyone looks at. They have decades of data. They tried iBuying. They put billions of dollars behind it, and it blew up in their faces.
True.
Why on earth should we believe Opendoor can survive, let alone succeed, when the industry giant couldn't make it work?
It's the right question to ask, and this raises an important point about the nature of competitive vacuums. Why did Opendoor survive? Part of it was pure scale. They were further along in the unit economics than Zillow was.
They've been doing it longer.
Right, and part of it was sheer determination. This was their core business, whereas for Zillow, it was an adjunct business line. But ironically, the exit of their largest competitors became their greatest asset.
How so?
It created a massive competitive vacuum. Opendoor was left as the last major player standing in the market.
So it's kind of survival of the fittest.
Yes, but more importantly, in the world of machine learning and AI, data is the ultimate currency. Because Opendoor was the only major player left actively transacting, actively buying and selling thousands of homes in a high-rate environment, they were collecting hyperlocal, real-time data on clearing prices, buyer traffic, and home conditions that no one else had.
Because Zillow stopped collecting new transaction data.
Exactly. Zillow's data was aging. It was from a zero interest rate environment. Opendoor was collecting live data in the new harsh reality. They secured a first-mover advantage in proprietary data collection that became virtually impossible for any new entrant to replicate.
Wow. Okay, so they took the pain, but the pain gave them the data.
Precisely.
Which perfectly sets the stage for the dramatic refounding of the company. You have this massive macro shock that essentially nukes the old business model. The old way of doing things, acting like a giant leveraged home flipper, is dead. What does the board do?
They realize they need a wartime CEO.
Yes. So in late 2025, they bring in Coz Najation to take the helm.
And just looking at Paz's transition package, you can tell the board knew they needed a heavy hitter to execute a severe, immediate course correction. Kaz comes with a serious tech pedigree.
He does.
He's a former lawyer, he was the CEO at Shopify, he held leadership roles at Meta, and he founded his own fintech startup, Cash. He operates in what Silicon Valley calls founder mode.
And the board paid up to get that founder mode energy. The filings show Kaz received a $15 million cash make-whole award, plus a $15 million restricted stock unit award.
And we should clarify for the listener exactly what that means. The board explicitly gave him this $30 million package to forfeit compensation he was walking away from at his prior employer.
Right. And for anyone who hasn't worked in the tech sector, let's explain what an RSU is. A restricted stock unit is basically a promise from the company to give you shares of stock, but they come with restrictions, usually vesting schedule.
You don't just get to cash it out immediately.
Exactly. So Kaz doesn't just get $15 million in stock to sell on day one. He has to stay at the company and usually hit performance metrics for those shares to actually become his. It locks him into the company's long-term success.
Right.
But even still, when you are putting together a $30 million package just to get a guy to walk through the front door, you are handing him the keys to the castle and saying, fix this, whatever it takes.
And Kaz Najation's approach to fixing it was immediate and, frankly, aggressive. And to really signal total alignment with this turnaround, it's worth noting he operates on a $1 base salary.
$1.
$1. His compensation package is tied exclusively to aggressive stock price milestones.
That is the definition of skin in the game.
It is. He branded this massive transition Opendoor 2.0, and during the Q3 2025 earnings livestream, which was his very first as CEO, he essentially published a manifesto. He didn't mince words. He stated unequivocally that they were refounding Opendoor as a software and AI company, not a real estate company, a tech company.
He made a very decisive break from the past. The cultural shifts he implemented right out of the gate were wild. He eliminated the company's reliance on external consultants, basically saying, if we don't know how to run our business, we shouldn't be paying outsiders to tell us.
Which is such a founder mode thing to say.
Completely.
Huh.
He mandated a return to the office, ending the remote work era to speed up iteration, and he announced the launch of over a dozen new AI-powered products and features.
But the most revealing part of his strategy, the part that really signals the pivot, was a quote regarding the fundamental business model itself.
What did he say?
He said, and I quote, "Our business will succeed by building technology that makes selling, buying, and owning a home easier and more joyful, not from charging high spreads and hoping the macro saves us."
Hoping the macro saves us. Out. That is such a brutal, honest assessment of the old iBuying model. Because for years, these companies were essentially acting like highly leveraged real estate flippers. They bought a house, and if the market went up 10% that year, they looked like geniuses.
But if the market tanked, they took a bath.
Exactly. They were at the total mercy of macroeconomic winds.
Precisely. Kaz looked at that and said, no, that's gambling. We are a tech company. We need to generate revenue through software-driven operational efficiency, not asset speculation. And this wasn't just corporate speak for an earnings call. We actually see it in the data, in the product shift toward what they call the Cash Plus product.
The Cash Plus product.
By Q4 2025, Cash Plus grew to represent 35% of their total weekly acquisition volume.
For those of you listening, this is a massive deal. This is the pivot in action. Can you explain why moving toward this capital light model, this Cash Plus product, is basically the holy grail for Opendoor survival?
The transition to capital light models like Cash Plus is the absolute core of the Opendoor 2.0 thesis. Let's compare the two models so it's clear.
Okay.
In the traditional first-party iBuying model we discussed earlier, Opendoor uses its own cash, or more accurately, massive lines of debt, to actually buy your house. They take the title, they put the physical house on their balance sheet.
They own the liability.
Exactly. They pay the property taxes, the insurance, the lawn care, and then they try to resell it. It is incredibly capital intensive and highly risky.
Right.
Cash Plus, on the other hand, is entirely different. It allows homeowners to utilize the Opendoor platform to sell their house on the open market, but with Opendoor's backing.
Wait, so they don't buy it?
Not initially. The seller gets the benefit of Opendoor's seamless digital tools, their pricing certainty, and importantly, a cash-backed guarantee if the home doesn't sell. But Opendoor doesn't have to take the full asset onto its balance sheet for a long duration. They are facilitating the transaction, not holding the bag.
It's acting more like a marketplace or an exchange rather than a pawn shop that holds the inventory.
Yes, exactly. That is a brilliant way to conceptualize it. This dramatically reduces the company's capital intensity. It drastically lowers their exposure to sudden macroeconomic shocks.
Because if they don't own the physical house,
They don't take the massive, painful write-down if the Federal Reserve decides to spike interest rates the very next day. They generate their margin through service fees, transaction fees, and adjacent services like title, escrow, and mortgage originations, rather than relying on the hope of asset appreciation.
so it really is a total structural teardown. They didn't just pivot slightly, they stripped the house down to the studs and rebuilt the foundation.
A complete refounding.
But this raises a huge, glowing question in my mind. If you were going to be a software company and you were going to rely on efficiency rather than just riding the wave of home price appreciation, your software better be incredibly, insanely accurate at pricing these homes.
It has to be perfect.
You cannot make mistakes. And that brings us to the core of this turnaround, the tech moat. How does a software company actually price a house accurately from thousands of miles away without sending a human with a clipboard out to look at the foundation and smell the carpet?
This is where Opendoor's proprietary data advantage, which we discussed earlier regarding the survival of the existential winter, really comes to the forefront. The filings and technical releases detail the sheer volume of their data collection, and it is staggering.
How much data are we talking?
Over their history, they have conducted over 850,000 physical and digital home assessments.
850,000. That is a massive data set.
It is unparalleled in the industry. And during each of these 850,000 assessments, they collect an average of 150 specific granular data points per home and its immediate surroundings.
150 points just on one house.
Right, on every single house. They aren't just looking at the public tax record for square footage, the number of bedrooms, and the year it was built. They have built a robust proprietary data library that has led to approximately 2.3 billion annotations and adjustments to public MLS and tax assessor data.
Wait, 2.3 billion adjustments. So they're basically saying the public data that everyone else uses is wrong or incomplete.
Exactly. Public tax records are notoriously inaccurate. A homeowner finishes a basement without pulling a permit, or adds a half bath, and the public record never reflects it. Opendoor has the actual ground truth data.
That makes sense.
Furthermore, they have built out incredibly unique geospatial data assets. They know the exact proximity of a home to high-voltage power lines, or to a 4-lane busy road, or to a commercial zoning district.
Because that drastically changes the price.
And because of their transaction history, they know exactly how much of a discount the open market applies to a house that backs up to a highway down to the penny versus a nearly identical house tucked safely inside a quiet cul-de-sac.
Okay, here's where it gets really interesting. Because they are not just relying on static maps and historical tax records to figure out if your house is worth buying. They have integrated multimodal AI to extract real-time condition data. Let's paint a picture for the listener. Imagine you are selling your house tonight. You download the Opendoor app, you take your smartphone, and you just do a quick 2-minute video walkthrough of your house. You pan across your living room, you walk into your kitchen, you show the bathrooms, and you upload that raw video to Opendoor.
And what happens next is the magic of the 2.0 platform.
Right. Their computer vision algorithms analyze that video in real time. It's not a human watching the video, it's an AI.
It's all automated.
The AI identifies, okay, this kitchen has cheap Formica countertops instead of granite. Or the carpet in the master bedroom is severely worn and needs replacing. Or the cabinets are solid oak, but they are from 1995 and need refacing.
It catches all of that.
The AI automatically categorizes this condition data and instantly calculates the exact renovation cost required to bring that specific home up to maximum market value in that specific zip code.
It goes even further than computer vision. It is truly multimodal. It extracts intent and context from your chat conversations with their support team. It is absorbing text, still images, video walkthroughs, and geospatial data simultaneously to form a holistic, hyper-accurate pricing model.
But let me ask you this, playing devil's advocate again. What if the lighting is bad in the video? What if the homeowner intentionally avoids filming a water stain on the ceiling? A human appraiser would catch that walking through the door. How does the AI account for people trying to hide things?
It's a great question, and it comes down to the law of large numbers and the 2.3 billion annotations we mentioned. The AI has been trained on hundreds of thousands of post-purchase inspections.
Oh, so it knows what people hide.
It knows that if a home of a certain age in a certain neighborhood has a specific type of plumbing, there is an X% probability of a leak. It builds a risk premium into the offer based on historical patterns of hidden defects. What's truly fascinating here is the contrast between this multimodal AI and the traditional appraisal process that the rest of the industry still relies on.
The guy with the clipboard.
Exactly. A traditional human appraisal is inherently subjective, and more importantly, it is backwards looking.
Right, they use comps.
An appraiser looks at recent comparables homes in the neighborhood that sold 30, 60, or 90 days ago and makes human judgments to adjust the price. But those comparables represent the past. They represent what a buyer was willing to pay 3 months ago under a potentially different interest rate environment.
Which is useless if rates just spiked last week.
Exactly. Opendoor's AI creates what is known in machine learning as a virtuous cycle.
Let's define that virtuous cycle for the listener.
A virtuous cycle in machine learning means the system gets smarter and more accurate with every single action it takes. Every single transaction Opendoor makes, every home visit logged on their app by a prospective buyer using their smartphone to unlock a door, every piece of visitor feedback left after a self-tour.
Like saying the kitchen felt small.
Or the yard was great. All of that unstructured data feeds directly back into the core pricing model.
It's a living, breathing algorithm.
Precisely. This allows their pricing system to dynamically adjust to microeconomic conditions in real time, not 90 days late. If foot traffic tracked via their digital locks drops by 15% in a specific zip code over a rainy weekend, the AI instantly calibrates its acquisition pricing for that neighborhood on Monday morning. It knows demand is softening before a human appraiser even wakes up.
So what does this all mean for the consumer? It means we are entering a world where an algorithm legitimately knows more about a neighborhood's true real-time clearing value than the people who lived in that neighborhood for 20 years.
It completely removes the human emotion from pricing.
No more of that. Well, I think my house is worth more because I planted those beautiful rose bushes in the front yard. The AI looks at the data and knows exactly what the open market is willing to pay for those rose bushes today, down to the exact dollar. And the proof that this massive company-wide AI overhaul is actually working isn't just theoretical. It is right there in the Q4 2025 turnaround metrics.
Which brings us to the most critical part of our analysis, the proof of concept. The fourth quarter of 2025 was the crucial proving ground for the Opendoor 2.0 strategy. Kaz and his team needed to show the market and their deeply skeptical shareholders that this wasn't just theoretical tech speak.
They needed to show the new AI engine could actually generate profitable unit economics in the real world.
And they took a very modern approach to showing those numbers. They didn't just host a boring audio-only earnings call for Wall Street analysts. To broadcast this, management held a financial open house that was live-streamed across Robinhood, YouTube, and X.
That is super interesting.
It demonstrated a commitment to transparency and direct-to-retail investor communication that you rarely see from traditional corporate executives.
And we also saw Kaz Najatian recently making waves by offering 4.99% mortgage rates, which is a full percentage point below the national average, just to boost volume on the platform.
It's all about feeding the machine.
Exactly. It was a very deliberate move. And when we look at the core information released during that Q4 presentation, we see a fascinating set of diverging metrics that tell a very cohesive, powerful story. First, let's look at the top line. Total revenue showed a sequential decline, dropping down to $736 million in Q4 from $915 million in Q3.
Which is a big drop.
Right. Now stop right there. Normally, if you are an investor or just a casual observer and you see a company's revenue drop roughly 20% quarter over quarter, you hit the panic button. The sky is falling.
You would absolutely panic.
But in this specific context, with this specific turnaround plan, that revenue drop is actually a good sign, isn't it? Let's unpack why shrinking revenue was exactly what Kaz wanted to see.
It seems counterintuitive, but it comes down entirely to inventory health. That sequential revenue decline was due to the intentional, disciplined clearing of legacy inventory.
The old houses.
Under the old pre-2.0 model, the company was holding on to bad inventory. These were homes bought before the AI pricing engine was fully optimized, or homes that were trapped on the balance sheet by the macro interest rate freeze we discussed earlier. They were toxic assets dragging down the company's capital efficiency.
So they basically ripped the Band-Aid off.
Exactly. Management made the difficult but necessary choice to aggressively clear that stale inventory off the books, even if it meant taking a hit to the top-line revenue and selling at compressed margins. They prioritized cash flow and balance sheet health over vanity revenue metrics. And we can see the massive success of this strategy in the days in possession metric.
Which measures how long they're holding the bag.
Right. They reduced their inventory days in possession by a massive 23%.
Wow.
Furthermore, the percentage of homes sitting on the market for greater than 120 days, which, as we discussed, is the absolute danger zone for iBuyers, where holding costs destroy any potential profit margin, that percentage dropped from 51% in Q3 down to a much healthier 33% in Q4.
I love to think of it like cleaning out a clogged drain. You have this old stagnant water, the bad legacy inventory just blocking the pipes, stinking up the place. You have to flush all of that out. You have to take the temporary hit of dealing with the mess so that the fresh, clean water can actually flow through the system.
That is exactly what they did.
And that fresh water is the new acquisitions powered by the 2.0 AI pricing engine. And boy, did the new water start flowing. While revenue is intentionally dropping as they cleared the old drain, their actual homes purchased jumped a massive 46% quarter over quarter.
That is the metric that shows the engine is turning back on. They went from acquiring 1,169 homes in Q3 to 1,706 homes in Q4.
Right, so they're shrinking the bad stuff and rapidly growing the good stuff.
Precisely. And this brings us to what is arguably the most critical data point of the entire turnaround narrative,
Right.
The October 2025 acquisition cohort.
Let's define a cohort for the listener.
In the real estate industry, and in iBuying specifically, performance is often measured in cohorts. It means grouping all the homes acquired in a specific month to see how that specific batch performs over its entire life cycle, from purchase to renovation to resale.
Oh.
The October 2025 cohort is incredibly important because it was the first full month operating under the strict Opendoor 2.0 model, utilizing the new multimodal AI pricing and the leaner operational cost structure.
So this is the first batch of pure fresh water through the clean pipes.
Yes. And the filings state that this October cohort is tracking as the strongest in the company's entire history. These newly acquired homes are selling at twice the velocity of the October 2024 cohort.
Twice as fast.
Over 50% of the homes bought in October were already sold or under a binding resale contract by the time the Q4 report was published.
That is the holy grail. It proves that the new machine actually works. It proves that they can acquire homes at scale, price them accurately using the AI, and flip the asset fast enough to secure a real, tangible profit margin without having to sit around and hope for the macro housing market to appreciate and bail them out.
And you mentioned earlier, the company has an aggressive target of 6,000 quarterly purchases by the end of 2026.
Right.
During that Q4 live stream, management laid out 3 core objectives that they are holding themselves publicly accountable to. Number 1, scale acquisitions.
Hence the 6,000 target.
Number 2, improve unit economics and resale velocity. And number 3, build operating leverage. We just saw them emphatically hit objectives 1 and 2 with that 46% jump in purchases and the blazing fast transaction velocity of the October cohort.
But objective 3, building operating leverage, that is the ultimate key to unlocking their stated goal, which is reaching adjusted net income break-even by the end of 2026 on a 12-month go-forward basis.
Let's define what building operating leverage actually entails for a tech platform like this. It means being able to dramatically increase the volume of output, in this case, the number of homes you process, buy, and sell, without having to proportionally increase your fixed costs.
Right. If you buy twice as many houses, you don't want to have to hire twice as many employees.
Exactly. Because Kaz eliminated the reliance on expensive external consultants, centralized their operations by bringing people back to the office, and, crucially, automated so much of the complex underwriting and condition assessment via the AI models we discussed, the fixed cost base is incredibly lean.
So every extra house is pure profit.
Therefore, every incremental home they buy and sell now drops significantly more pure profit to the bottom line. The machine is built, the algorithms are trained, now they just need to feed it volume.
And clearly the market is starting to pay attention because we saw a recent 17% post-earnings rally.
We did.
But investors remain somewhat divided over this aggressive goal of hitting break-even by late 2026. So, to ensure that the management team stays laser-focused on feeding that machine and generating actual tangible shareholder value, the company introduced one of the most unique, aggressive financial instruments we have seen in public markets in recent memory: the warrant dividend.
Which is a brilliant transition to the final major piece of this puzzle, structural alignment.
Yeah.
This is a topic that rarely gets the attention it deserves in corporate finance, but it is the ultimate test of management teams' belief in their own turnaround.
I absolutely love this part of the story because it's so incredibly rare. In November 2025, Opendoor announced a warrant dividend distribution to their existing shareholders. For every 30 shares of common stock you held in your brokerage account on the record date, you automatically received 3 different warrants deposited directly into your account at absolutely no cost to you.
Free capital.
One Series K warrant, one Series A warrant, and one Series Z warrant. These aren't hidden private contracts either. They are fully tradable, listed right on the NASDAQ under the tickers OpenW, OpenL, and OpenZ.
They even made sure that holders of their 2030 convertible notes received these warrants as if they held the underlying common stock, which was a massive olive branch to their debt holders.
Wait, before we go further, what is a convertible note? Because we're throwing around some heavy financial jargon here. Let's make sure the listener's right there with us.
Of course, a convertible note is a type of debt, a loan made by investors to the company, but it has a special feature. The investor holds the right to convert that loan into shares of the company's stock at a later date instead of just getting their cash back with interest.
Got it.
It's a hybrid between debt and equity. By giving these note holders the warrant dividend too, Opendoor essentially rewarded everyone who had capital tied up in the company's future. But for our listeners, we need to clearly explain what a warrant actually is and why issuing them as a free dividend to retail investors is such a bold structural move.
Let's break it down. Explain it like I'm 5. What is a warrant?
Simply put, a warrant is a financial contract. It gives the person holding it the right, but absolutely not the obligation, to buy a newly issued share of the company's stock at a specific predetermined price, which is known as the strike price, before a certain expiration date.
It sounds a lot like a call option.
It is very similar to a call option, but with one massive key difference. Options are secondary contracts traded between 2 independent investors on an exchange. The company itself is not involved. Warrants, however, are issued directly by the company itself. When a warrant is eventually exercised by the holder, the company issues a brand new share of stock. This brings fresh cash capital into the company's treasury, but it dilutes the ownership percentage of all the existing shareholders. Normally, companies use warrants as a sweetener. They hand them out behind closed doors to hedge funds or private equity firms when they're trying to raise expensive debt as a little bonus to get the deal done. To distribute warrants broadly out in the open to all retail and institutional shareholders as a completely free dividend is highly unusual.
And Kaz Najation's quote on why they did this is just legendary. It goes right back to that founder mode energy. He said, "Public markets have a long history of taking shareholders for granted. Real alignment isn't a slogan, it's structural. If we win, you win, not theoretically, but practically and by design."
It's a powerful statement.
He was addressing the elephant in the room. Retail investors rode this stock all the way down during the existential winter. They suffered massive, painful portfolio losses, while executives often still collected FAD-guaranteed base salaries. Kaz is looking at the retail investor and saying, "We are putting our money where our mouth is. We only win if you win."
And we see that structural alignment clearly when we look at the specific strike prices on these warrants. Series K has a strike price of $9. Series A has a strike price of $13. Series Z has a strike price of $17.
Those are ambitious targets.
They also have trigger prices set at 120% of those strikes, meaning $10.80, $15.60, and $20.40, which relate to forced exercise mechanics.
Okay, you mentioned a trigger price and forced exercise mechanics. What does that mean for the average person holding these warrants?
A forced exercise mechanic is a clause built into the warrant by the company. It essentially says if our stock price performs incredibly well and hits this higher trigger price, say $10.80 for the Series K, and stays there for a certain number of days, we, the company, have the right to force you to either exercise your warrant right now or we will redeem it for a nominal fee.
Oh, I see.
It allows the company to clean up its capital structure and force the cash to come in the door once the stock has proven it can hold those higher valuations.
Got it. So it forces action once the company actually delivers on its promises.
The design of this entire warrant dividend achieves 2 brilliant strategic goals simultaneously. First, it provides immediate, tangible liquidity and choice to long-suffering shareholders. On day one of the issuance, a shareholder could log into their brokerage account, see these new OpenW, OpenLN, and OpenZ tickers sitting there, and sell them immediately on the open market for cold, hard cash. It was an immediate value transfer to the shareholders.
They didn't have to wait.
Or, if the shareholder believes in the turnaround, they could hold them, participating in the massive leveraged upside if Kaz and his team pull this off.
What is the second strategic goal?
Second, it protects current shareholders from immediate dilution. Because a warrant only turns into common stock if the actual stock price reaches that strike price and the holder exercises it, there is absolutely zero dilution on the day they are issued. The pie doesn't get sliced any thinner today. It only dilutes the pool if the company creates massive value first, driving the stock price up to $9, $13, or $17.
So what does this all mean for the company's roadmap? By tying the management's success directly to these specific, aggressive stock price milestones, they have effectively published their internal roadmap for value creation for the whole world to see.
Everyone knows the targets.
They aren't hiding behind vague corporate speak promises of long-term synergistic value or adjusted EBITDA improvements. They are drawing bold lines in the sand. Kaz is effectively telling the market, judge my turnaround by whether or not we hit $9, $13, and $17.
It forces intense, undeniable structural alignment between the C-suite executives making the decisions and the retail investor holding 100 shares in their Robinhood account. If the turnaround fails and the stock languishes at $3, the warrants expire completely worthless and the executives don't get the windfall.
But if the AI engine works, the volume scales, and the stock hits $20, everybody wins massively together.
It is the ultimate put-up-or-shut-up maneuver in public markets.
And if we connect this all to the bigger picture, it forces us to evaluate the sheer scale of the puzzle Opendoor is trying to solve. We started this deep dive talking about a $2.3 trillion industry that is fundamentally trapped in a localized, offline, high-friction model from the 1980s.
A Rube Goldberg machine.
Exactly. Opendoor survived an unprecedented macroeconomic shock that literally wiped their primary competitors off the map. They've taken that survival and leveraged it into an insurmountable data moat. They refounded their entire culture. They rebuilt their pricing engine from scratch using multimodal AI that watches videos of your living room.
It's incredible.
And they aligned their corporate structure with shareholder outcomes in a highly public, highly aggressive way. The Q4 2025 metrics, that massive jump in acquisitions and velocity show of the flywheel, is finally beginning to spin again.
Which brings us to the end of our journey today. Why should you, the listener, care about all of this? Why does Opendoor matter to you?
Yeah, what's the takeaway?
Because unless you plan on renting the exact same apartment for the rest of your natural life, you are going to interact with the residential real estate market at some point. The survival, the evolution, and the potential triumph of this platform matters to anyone who ever plans to buy or sell a home. They are actively trying to rewrite the fundamental rules of the largest financial transaction you will ever make in your life, turning a 90-day, stress-inducing nightmare into a seamless digital tap on your phone.
And that leaves us with a final provocative thought for you to mull over as you go about your day. We have spent an hour detailing how Opendoor's multimodal AI is learning, transaction by transaction, to perfectly predict the exact clearing price of any home in America down to the precise dollar value of a scuffed kitchen cabinet. If they achieve their ultimate vision and their AI can instantly price and provide immediate cash liquidity for any home, anywhere at any time, how will that fundamentally change the very nature of home ownership in this country?
It's a profound question. If homes eventually can be traded with the exact same frictionless instant liquidity as a share of Apple stock, what happens to the concept of the family home? Does a house simply become another highly liquid node in a retail investor's diversified portfolio, traded on a whim from a mobile app?
It's wild to think about.
And if so, are we ready for the societal implications of neighborhood real estate moving at the hyperspeed of software?
We hope you enjoyed this deep dive, and thanks for listening. Please follow us and subscribe on your favorite platforms. Don't forget to check out our Substack, Delta Investments. Until next time.
This analysis is based on publicly available information and does not constitute financial advice. Always conduct your own research before making investment decisions. By listening to this podcast, you agree that you are in charge of your own decisions and risks, and that you are solely responsible for any investment decisions you make.